Have you wondered what financial advisors actually think about finances? This is your sneak peek at the conversations within Financial Design Studio. Michelle Smallenberger, the CEO here, will be your host as you go behind the designs.
Hello, everyone, and welcome to Behind the Designs. My name is Michelle Smallenberger, your host, and here at Financial Design Studio, we help people look at the opportunities they have and build a plan to use them to the fullest. If you're a corporate executive, one of the opportunities you might have is equity compensation. Now, this can be a really complicated topic, so today I have invited Trevor Meyer to join us. Trevor, welcome.
Thanks for having me. Happy to be here.
Great. Well, Trevor is our COO and a financial advisor here at FDS. And when we're talking about equity compensation, everyone's is different. Every company's is different. You really enjoy kind of analyzing all of these details, right?
I do. It's always one of the fun things to kind of work through, recognizing that every plan is different. Every plan's unique. Every stock plan has its own little quirks here and there that you have to be mindful of, whether it's a vest schedule, grant schedule, any shape or form. But at the end of the day, like, they're always numbers. It's always a puzzle to sort out how is this going to apply for a particular client, and quite frankly, how can we optimize? How can we maximize it for them, just to make sure that they're getting the best that they can for it. So it's fun.
Yeah, no, and I appreciate that about you. So I think it's great. Well, we're going to dig into a lot of the specifics of employee compensation, with your employer, and kind of talk about different ways you get compensated, the specifics of those, and then kind of wrap it up to where, like, the importance of planning for that and just a lot of the nuances from the time where you're thinking maybe 10 years before retirement and then you retire and then beyond. So really kind of walking through that timeline with these different forms of equity compensation. So hopefully this is really helpful for someone trying to understand all of these details. So let's start here just at the very, top. So really what we're talking about with equity compensation is that a company, when you go to work for a company, it's very common. Anyone can relate to this. You get a salary, you get paid for the job you're going to do. But with some jobs with executives of different levels, you also get paid with stock. So stock with your employer. And that's, an additional incentive. So why don't you kind of walk us through some of these ways that people, that executives are paid, whether that's with, just straight pay like salary or equity. Just walk us through some of those examples.
Sure. Yeah. So I'm kind of a simple guy. I love to make things really, really simple because I get confused pretty easily. So just kind of working it down to say the simplest form of payment that you get from the company is simply your salary, as you mentioned, and just kind of working through that. How can we amplify that? How can we make that better for your case as an executive? It kind of comes from the company doesn't necessarily want to pay you that money right away because they want to keep you on the hook. They want to keep you around to make sure you're hitting your growth targets, making sure you're hitting your project plan deadlines, whatever the case may be. So that's where equity compensation starts to come into play. But in terms of the types, they're generally kind of a not too many types, but they all kind of carry their own different unique aspects. So one of the big ones that we see is RSUs, which is restricted stock units. Those basically come in where you have a grant from the company and it's subject to a vesting schedule, whether that's a year, 3 years, 4 years. 4 years is most common that we see. And essentially the longer that you work for the company, you'll be you'll be vesting in those grants that were made available to you. It's really common for RSUs to see that when you initially sign on with a company, whether it's a technology company, we have a lot of clients that work for various tech companies and whatnot. It's a really common hiring process to say, hey, here's your salary going to be this, and here's your initial award, whatever that's going to be. And that's going to translate into however many different RSU that you'll be able to receive and then vest over time. So the interesting thing there with RSUs is it's kind of set it and forget it almost to a large degree. There's nothing you have to functionally or actionably do. The company does tend to just take care of it as you vest. The shares will be made available to you. Just about all cases that I think we've seen, they'll withhold funds available for you. Most of the time it's at 22%. But once your income exceeds a certain threshold, they can bump that up, or the company can provide another election to say, hey, we know you're going to be in the 32% tax bracket or the 24. Let's change that so that way we don't have to accommodate and make changes to the tax plan otherwise. So I recognize already that I'm drilling into details with RSUs, but so that's basically one big option. The other kind of really common ones that we see are actual stock options, and those generally take the form of ISOs, which are incentive stock options, or NSOs, non-qualified stock options. Really, the big crux here is to think that there's actually something that you have to do. So in this case, you're granted the ability, but not the obligation, to purchase the company stock at a future date for a set price. So this is a situation where, let's say the company is growing really, really well and very, very quickly. It might be a situation where, hey, your strike price is really low, but the actual fair market value is quite high. So there's a spread there. There's a value that you can receive. Really, the difference between ISOs and NSOs really comes down to the taxation of them. So you have some limitations with that, but then there are other details that you can do with trying to minimize that tax impact. So it's all a big picture, it's all a big puzzle, and just trying to find what levers make the most sense for you. So.
And we're going to talk about some of those details. We'll get into the kind of the how and when to exercise and what to know about taxes. So yeah, I think it is interesting. And you mentioned this, like RSUs have definitely become one of the more popular forms of equity compensation that we are seeing for people as they start, working with different companies. So it is interesting that you see less and less of the stock options, and more of those restricted stock units.
Yeah, and I would say the nice thing with RSUs that makes it kind of relatively easy is it's relatively consistent, right? So let's say someone signs on with a company, they'll have an initial grant. Generally for the clients that we see, if you're getting RSUs regularly, you're going to be getting them on an annual basis. So a lot of comp reviews happen around March, maybe sometimes April, but March is a very consistent timeline. So you kind of get those refresh awards coming through around that time period. The other nice thing is most of the time the vest schedules stay consistent, which is kind of nice. So that way, from a planning perspective, you don't have overlapping grants that are bumping up taxable income in a certain year or dropping it tremendously in another year. But that said, I kind of get excited because when we do have those changes happening, now those are actually tax planning opportunities to say, hey, we're going to have higher income this year. If we're charitably inclined, is this a year in which we're projecting we're going to bump to a higher tax bracket? Hey, maybe we want to do a larger donor advised fund contribution so that we can get more potential value out of those shares. I just talked to another client this morning where for the longest time that they had a consistent vest schedule of 4 years and spread it out. Now they're transitioning to, it looks like, a 3-year vest schedule. So just some planning changes and considerations to keep in mind. Not that it's anything bad, just we want to not always set it and forget it.
Yeah, and I think that especially just so what we've just talked about is really equity compensation. So we mentioned kind of in the beginning, like salary is one big piece of that. So you always want to make sure that you're competitive with that. Other things that people can also get are, just even benefits. So when we talk about, kind of benefits that might be like life insurance, disability insurance, pieces like that, health insurance. So there's those. What about some others? So these are also kind of it comes from income or is in addition to, but kind of pieces like deferred compensation. What are a few others that you can think about there?
Yeah, so deferred comp is a big one that you already mentioned. That's basically a plan where you're essentially electing to say, hey, the company gives you this opportunity and say, hey, your salary is X. For example's sake, because I tend to think simplistically, let's say your salary is going to be set at $200,000. With the deferred comp plan, you can say, well, I've already deferred the maximum into my 401k, but I don't want to have more income because let's say you don't need the income right now. You can elect under the deferred comp plan to say, hey, I'm going to push more of my income today out to a future date, generally when I retire. And the nice thing here is, the company will hold those funds for you, and you can invest those a lot of times. The investment options, you want to check them just to make sure that they're good ones. We've seen plans where they're not, so we've seen plans where they're not great investment options, and therefore maybe that's a contributor as to whether you don't participate in the plan. But assuming that you do, generally you actually get to make an election to say, hey, when you retire, whether that's 60, 65, 63, or maybe even earlier, depending on the plan, you can say, hey, do I want that money as a lump sum, and roll that over where it needs to be, or do I want to spread that out over a 5-year, 10-year period, or whatever the case may be. So the deferred comp plan basically allows you to defer compensation from today into the future. So that's a pretty simplistic way to look at it, but there are a lot of details to keep in mind. The other one that comes to mind is ESPP, which is Employee Stock Purchase Plan. That is actually a situation where in your regular paycheck that you're getting, you are saying, hey, I really like my company. I would love to continue investing in them. So I'm going to take money out of my paycheck and put it back into the company in the form of company stock, purchasing it in an ESPP plan directly. Generally, you're limited to how much you can contribute to the plan. Call it like $10,000, maybe $11,000 a year or something like that. But the nice thing with these plans is there are terms in here where you can actually get a discount on purchasing the stock, right? So let's say the company stock is trading at $100 a share. A lot of times the discount we see is about 15%. So rather than buying it at $100 a share, you get to buy it at $85 a share. So just there alone, you have a $15 gain on those shares, which is wonderful. The other nice thing is there's definitely language to say every 6 months there's a purchase period, so you can get the lower of the price within that window, plus a 15% discount. So there are also additional considerations to say this could be really valuable, especially if it's a company that is consistently growing on a regular basis. So.
Yeah, no, I think those are, really helpful. It's interesting because there's such a long list of some of these benefits. Just a couple more that I even think of is like, profit sharing on top of your 401k. That's another, and then pensions. And again, not every company has a pension, but if you do, that's another valuable benefit. So like even just listing all of these out, there are companies that might have all of these. And so, or, it may not even be like your employer, but for example, different types of executives. So a high level executive versus kind of a mid-level executive, might have only a few of the equity compensation available, those options, but someone who's a higher level executive might have all of these. And so this is where, really understanding the details between all of these matters. So when we kind of talk about, I guess, all of the types, now one of the things that we're always trying to be careful of and make sure that executives are careful of when they are investing in their company and they're also just getting awarded all of this equity compensation is that you can very quickly get so invested into your employer that now everything is coming from there. But if something happened to your employer, that company you work for, everything can also be gone. And so it's that risk of these are great benefits, but how do I utilize them and kind of de-risk over time or minimize my risk as I'm working there, but also benefit from all of these forms of compensation. So it's kind of a really fine balance. So kind of walk us through, I guess, which ones of these are normally, some of these are optional. Some of them we're choosing to purchase. Some of them aren't. So just kind of explain which ones of these are normally optional, that this would definitely be something you need to watch out for because you're purposely choosing to own more in your employer company. Walk us through kind of the optional versus those ones that we probably don't have much options over. So then we kind of know what we're dealing with, like how to actually choose what we have.
Sure. So the primary optional ones are going to be the ESPP plan, right? Anything that you are objectively saying, hey, out of my paycheck, I want these dollars to come out for a particular purpose. So the ESPP is a really clear one, as is the deferred compensation plan. You can set both of those to zero. You can set those both to their maximum amounts. Different plans have different amounts for what those are, but those are fully optional. The other thing you could optionally do, I think you could also stretch this to say, hey, do I want to buy company stock within my 401k? So that's actually an option that's available as well if you want to invest in your company even more. That's one thing that you don't have to do because there should be other investment options available for you. You don't have to do that. That's a cost of consideration. The ones you don't really have so much control over, although depending on your level, you do have some control over, is kind of what your grants are going to be, whether it's RSUs or the ISOs and NSOs, the amounts that you're granted. Sometimes you can have a little bit of wiggle room to say, hey, I want to work with my manager and, I don't really need much income right now, but I really want to make sure that I'm partaking and participating in the future growth of the company. So that may be a situation where you can negotiate for more equity compensation instead of more cash compensation upfront. So
I think one of the biggest things is executives can start working for a company, and there's so many great benefits, the employer stock being one of them, especially if you're at a company where the stock is growing really rapidly. And so one of those things is we just want to be careful. We want, like I said, it's a balancing act of not overdoing it, getting too much, or it's this balancing act of, as you're getting it, how do we always also minimize the risk by, maybe we get this, but as it vests, we're taking it right back out of the plan and kind of getting it into other dollars. So I think that's actually a really helpful for people to understand, is no one is forcing you into all of this employer risk. Sometimes we're actually choosing it. And so it's very important to know the difference.
Yeah. And I think one thing I'd probably chime in and add is it's not uncommon that as we start working with someone, if they have a lot of these elements as part of their compensation package, one of the consistent things that we might be saying, now again, every client is unique and different, but we tend to find this rule is we're a lot of times advising folks to, hey, how can we diversify away? Not that we don't want you to participate and partake in your company's growth, but especially with a lot of folks that we work with where, hey, maybe there's only one spouse that's working. That one spouse is working at the company, your health insurance is coming from the company, your salary is coming from the company, your equity compensation is coming from the company, your 401k is there. If you're putting, 401k money in company stock as well, you're really kind of siloing and you're putting, quite frankly, all your eggs in one basket in your company. We tend to firmly believe that diversification is a really wonderful, powerful tool. And it's not uncommon for us to suggest to a client to say, hey, as these RSUs vest, let's make sure that we're selling those within a trading window. We want to be mindful and careful of that. But we're selling those and diversifying into a broader basket. Or, hey, in this slew of, or this year for your 401k, let's start diversifying away from some of that, some of the company stock that you purchased in your 401k. Recognizing that, hey, there are potential tax impacts down the line with potential NUA, but at the end of the day, we don't want to let the tax tail wag the quote-unquote portfolio or investment dog of making sure that your broader financial plan is actually safe and sound. So
that's exactly, when we talk about these, I want to make sure that people know about other resources that we have available. So one of the things that we even just recently talked about in this video, where we talked about the difference of the kind of voluntary equity compensation that you're able to purchase versus this involuntary that you're given, we actually talked about how to calculate how much of your employer you really have of your entire portfolio. And that's one of the biggest things. A rule of thumb that we kind of have is keeping 10% or less of your total portfolio in your employer's investments or employer stock. And that's just one thing that I think it's, again, just kind of a reminder because it's easy to get a lot in there. And like you just mentioned, you said, even if we're going to sell it in the 401k, there's potential NUA that we might be not able to take advantage of later. And so you really have to look at the pros and cons of each of these moves, and this is what we always say when clients come to us. We're saying, we're looking at everything as it is today and going forward. So we aren't looking at this and saying, oh, I wish you would have done this or made this decision. Like, what's done is done for the most part. And now we're saying, what can we do with what we have and how can we make this better with the opportunities that you have going forward?
Yeah. To add on to the point hey, what's happening today versus what will happen in the future. Like the client I talked to this morning, the implication there, let's assume these equity grants are going to stay consistent. Well, now when you move to a 3-year vest versus a 4-year vest schedule, well, we've got all these other ones pent up, built up, looking for, the past couple of years because they've worked there for a number of years. Well, now we've got a situation where there are going to be a couple of years where income's going to spike up, assuming all else stays equal. Recognize other stuff can change. So it's one of those things where, hey, if we just assumed for your financial plan, 4-year vest schedule, you're good to go, that's what we're going to rock and roll with. The reality is, no, there's a lot of other planning options that as things change, we have to adapt and modify the plan to make sure that you're taking the best options that you can.
Exactly. And that really leads us well into kind of this next piece that we really want to talk through. So Trevor, you kind of started mentioning some of the details with each of these specifically. And this is where, it kind of highlights the importance of really planning everything together, because we're going to kind of break down each of these pieces and talk about you're given these or you purchase them, and we're going to kind of break out how to exercise them or, quantify them, or how they actually, become real dollars versus just shares that aren't invested yet. Then kind of when to exercise, when you can exercise them, and then just even what to know about taxes. So with each of these pieces, there's something unique with them tax-wise, which is what makes them different, because there's some way that they're treated differently than the other. So we're just going to kind of talk about each one so that if this is helpful just to understand, what you actually have and how it actually works on its own. And then we're going to kind of say, okay, let's put this into a picture of someone who's retiring. How do they really need to be thinking about all of these collectively and together to achieve what they're trying to achieve? So we're going to spend some time on this section here. Why don't we kind of start with, and I kind of feel like, in just working with clients, I kind of say I feel like these are older ways of compensating people through company stock. And so I would say that's kind of like incentive stock options and non-qualified stock options. So just stock options, themselves. I don't see them as much anymore. It does not mean that they don't exist. I just feel like there's kind of been this shift or transition to more RSUs instead of stock options. So let's just take those incentive stock options first, and then we'll kind of compare them to how non-qualified stock options are different. But why don't you talk us through kind of that, how you exercise them, or from the time they're given to you, and what we should watch out for taxes for that.
Sure. Yeah. So ISOs up first. The big thing to remember with ISOs, again, that's incentive stock option is what ISO stands for. I'm very common. I use a lot of acronyms, so I have to slow myself down. I apologize. But yeah, so working with the incentive stock options, essentially, as I mentioned before, this is the option. You have the right, but not the obligation to purchase company stock in the future. So let's say for our example right now that you are granted an ISO for 1,000 shares at, let's say, a strike price, which is the price you get to purchase it at, of $10. If the company stock in this example, unfortunately drops down to, let's say, $3 a share or $4 a share. Well, in this scenario, you can hold the option, but you never actually exercise because really you don't ever want to have to put up your $10 a share, basically $10,000 to purchase something that's only going to be worth $3,000 or $4,000, right? That doesn't make financial sense. Where it does make sense is to say, hey, the $10 share that you were granted at for your strike price, let's say that's $20 or $30 a share now. Now we're in a situation where we get to buy something that's valued at $20,000 or $30,000, and gosh, I only had to pay 10 grand for it. That's a wonderful trade-off. Now the IRS knows this. That's one of the reasons why we tend to find maybe this is decreasing a little bit, but there's gain associated with that, and it gets kind of complex. So with an incentive stock option, so long as you meet the holding requirements, which are a year after grant and a year after vest, or excuse me, a year after option. year after strike, basically you exercise the option. As long as you meet those holding period requirements, you actually get long-term capital gain treatment on the value of that stock, which is really great because that means instead of paying upwards of 24%, you're going to pay 15, maybe 20%, depending on your scenario. So that's where the incentive portion comes in. Your tax rate is going to be much, much less. The considerations here you have to be mindful of are, because you have that bargain element, what the value is would have been otherwise, now you're actually introducing the realm of AMT. You may have been in your tax scenario for other reasons as well, but we tend to find this happens a lot with clients and ISOs, where they have a whole lot of ISOs that have been exercised and now and sold, or not even necessarily sold, but either way, you start to introduce AMT in terms of what is the actual tax rate that you have to pay, right? So if you were to follow your tax return down every single line, you can actually kind of follow it decently. It jumps around with different schedules and this and that, but you can kind of track to figure out what the math is. Unfortunately, as soon as you introduce AMT, well, now you have a whole completely different schedule with how you have to calculate your tax. And the downside with that is the IRS says, hey, here's this one schedule for one version. Here's the AMT schedule for another version. Recognize you have to run the calculation on both. The IRS is always going to choose, well, pay us whichever one's higher, which really stinks because, you never get a benefit. But in this case, AMT can be an additional tax in some regards when you start introducing incentive stock options because they are a hit item, an includable item for AMT purposes. So.
No, that's helpful. So just to summarize, ISOs, I'm given an option, an incentive stock option. And like you said, you might be given 1,000 options to purchase your company stock at a certain price. So you would want to purchase it if it's less than the actual value. And once you purchase it, then you can choose how long you hold it for. And then based on how long you hold it for, that will determine the gain that you're actually going to pay when you sell it. Is that right?
Exactly right. Yep. And you're basically going to pay tax on that gain. And, ideally, as long as you meet the holding requirements, you're only going to pay long-term capital gain treatment on that.
I think one thing that's really interesting with, as you've been explaining it, is that someone who has options, there's a lot of this language, like you mentioned acronyms and things, there's a lot of this language that is used, like these are the technical legal terms that are actually used. So we're trying to help you explain it, help you understand it very simply. But at the same time, understanding everything you're saying is really important because that helps them tie it back to the actual grant letters, for example, that they're given. And that's the language that's actually used in those documents versus just a very high level understanding. So I think that's really helpful as people are explaining this. So it's good that you're explaining, all the technical pieces of this.
It's funny you mentioned the grant letters. I think one of the annoyances that sometimes we get from clients are, we request a lot of documentation because it's amazing how much the details play into the broader financial plan. But one of the things that we oftentimes request are, can we get a copy of your grant document or your grant letter? Sometimes it's 5 pages, sometimes it's 1, or whatever the case may be. But the specific reason why is exactly what you hit on. All of those little details there play a substantial role in how that grant is actually going to play out the rest of your financial plan. And understanding what those impacts are going to be is really important for us so that we can give you good clarity as to say, hey, this is a good idea, or maybe this is not. The other thing I just wanted to add too quick on incentive stock options that I realized I forgot is sometimes you'll see these in private companies where you get the option, the ISO or NSO to say, hey, you can buy company stock and this and that. But the reality is you don't really have a market to sell it. Right? It's not in the same way that you could, publicly trade like Allstate stock or AbbVie stock or something like that, where, you can go out and, have a brokerage account at Schwab and you're selling it right away. That gets a little bit harder when you're dealing with a private company. It's not impossible. We've actually walked through with a few clients of, hey, here's how you do a private shared transaction and whatnot. But it is more difficult and it is more costly. So sometimes one of the recommendation things that we walk clients through is, hey, is there a market for your shares if you wanted to exercise and sell? And the reality is, if there's not a market, well, maybe we don't want to put these dollars necessarily at risk right now, because again, you have to put up money in order to exercise the option.
Okay, so let's touch on non-qualified stock options, so NQSOs, that are a little bit different. They're still options, but there is a difference between incentive stock options.
Yeah, so with these ones, similar in the regard that you still have a strike price, and you still have the price with which you have to purchase the option at. But the downside here is you're not ever going to be able to take advantage of that long-term capital gain treatment. So you're really kind of looking at income here when you exercise the option. So that's why ISOs, or incentive stock options, have that I, is because there's a little bit of incentive there. Now, one of the things that we can help do to mitigate some of that cost is there's an election that you can take called an 83B election. And really all that means is to say, you're telling the IRS to say, hey, I don't want to get taxed with a lot of money on this down the line because this is going to be really valuable. So rather than pay ordinary income rates on the gain that I would get on this stock or whatnot, I would rather say, hey, what's the value of it today? And I'll pay tax on that today. And now the IRS says, okay, hey, great, we'll take your tax revenue right away, because that's really what you're doing. Well, now let's say you vest in the shares over time and the company stock has grown really well. It's not an uncommon scenario that we see. Now, instead of converting ordinary income rate, which is what you would have on a non-qualified stock option, you'd have ordinary income rates. Now, with an 83B election, you convert that back to a capital gain treatment. So essentially what you're doing is you're exchanging a marginal tax bracket rate, 22, 24, 32%, 35% brackets, in exchange for 15 or 20% brackets instead.
And I think that's where it's interesting. There's just these little nuances that, in theory, very high level, they're options, just like that incentive stock option was, but they're a little bit different, in how they're taxed, and that's what makes them different.
The other quick consideration too with an 83B election I always just like to highlight is the language that the IRS uses is they have to be at a substantial risk of forfeiture. And one of the things to keep in mind there is, let's say you file that 83B election, but the shares never materialize. You either leave the company or something goes kaput, or for whatever reason they never materialize. The IRS says, oh well, good luck. Because the deal you're making is, hey, potentially get preferential tax treatment, but if it doesn't materialize, they're not going to give you that credit. So
yeah, I think, and again, we're talking we're really digging into it's a balance between which of these do I accept when I have the choice, which of them don't I. Even if I'm going to accept it, do I file an 83B election? Do I not? And so you have to weigh all of these pieces individually. You have to look at your company. You have to look at how you think the company's going to do. You look at a lot of these factors to be able to make those decisions. So that's really helpful. So for options, like I said, this is something that was offered a lot, in past years. I do feel like restricted stock units, RSUs, have kind of been the new stock option, kind of the new equity compensation of choice by employers. And I wonder if, maybe executives were kind of saying, wait, there's too much risk of forfeiture, or we don't know if there's going to be value. Was there, I don't know that we know for sure, but it is interesting just to kind of see the shift of going more to RSUs. I guess any thoughts you have on maybe why that is more prevalent today?
Yeah, actually, I have no data to back this up. This is purely anecdotal. But we have one client where, they have both ISOs and NSOs, where unfortunately they're underwater, meaning the value of the company stock has fallen. It hasn't grown, or it hasn't even kept up, right? So the strike price or exercise price is higher than the current fair market value of the stock. And the kind of thing that stinks here is, well, this client, if we were anticipating that there was a value, even a nominal value of part of the compensation package that frankly is not there anymore, by no association with what the employee has done, what our client has done, just a broader company. Well, now you're kind of in a situation where, well, the employees might look and say, well, what kind of benefit is this to me? Great, I can participate in the upside, but they don't necessarily control all the decision making from the C-suite, right? So some of that is lack of control, meaning when you don't have that control, then you don't get the benefit, which is not necessarily ideal. Whereas the flip side with RSUs is, regardless of whether the stock price goes up or goes down, there is always a value there. Unless, of course, the company stock goes to zero. And then at that point, they are worthless. But now we're actually talking about a different scenario of triaging with the client of, what that's going to mean in terms of the broader plan. But with RSUs, there's always a value there. So there's always something of, discernible, work that we can do something with. I would also say they're simpler. It's basically the way those work is they're subject to a vest schedule, as I mentioned before, and when that vest date happens, most companies that we see, they basically work with a stock option plan provider, whether it's going to be E-Trade, they're a common one, Card is a common one, UBS is common, ShareWorks, trying to think of the other ones. I'm sure there are a bunch I haven't mentioned, but whatever those are, it's just transactions where they're just in your account. And now you get to make the choice of, well, as long as you're not subject to a trading window, and the trading window is open, or you are subject to a trading window and the trading window is open, then you can actually say, hey, I'm going to sell that and I'm going to work with these dollars in a different capacity.
Yeah, I think it's interesting because really what we're talking about is this equity compensation, and it's really incentive compensation. So when we talk about it, when you're saying, is an employee actually receiving? So are these executives actually receiving an incentive to further the company, to make this project really great, to whatever those goals are that they're kind of maybe tied to or measured against? That's really, they're trying to incentivize something. So if at the end of the day, the stock price doesn't move because of that, like you just said, well, is it really giving them the incentive that they're trying to drive? So that makes sense. So for restricted stock units, it's just very simply they're vested. You're given, and then they vest over time. As they vest over time, you pay tax. And that is the beauty of them. You're right that they're very simple. What is one of the dangers, or kind of talk us through the danger where, people they get this stock, they don't have to do anything, but is that also something that can hurt them because they don't do anything?
Yeah, we've seen situations where clients will come in and they've worked at a company for years and they've just had this equity bucket, this RSU bucket, oftentimes where the shares have just grown and grown and grown and grown, and just the number of shares have just been deposited. They've not done anything with it, and that's okay. But it is one of those things where, hey, now we had a material difference between the value of the stock when they vested, now when the stock is much higher. Well, the downside here is we have additional taxes due because there's substantial gain there oftentimes. So now how can we mitigate some of those gains? Not that gains are bad, gains are actually really good. But if we don't have to pay as much tax, well, we don't want clients to pay more tax than they need to. So it's trying to figure out how can we kind of work through those. I think the other big risk that comes to mind for me is kind of the cash flow tax situation. And what I mean to say by that is it's not uncommon that we have clients that are in the 24, 32, 35% tax brackets. So when we're at that situation, and the RSUs most commonly, unless they're substantially higher valued, are generally only withholding at 22%. Now that doesn't seem like a lot or that big a deal, but the reality is at the figures that a lot of times we see for our clients, like it works out to material dollars. And if you're not planning for those in your tax projections, well, when you go to file your taxes, you're going to be in for a not so happy result because no one likes cutting checks to the IRS. They're not fun, but they are a requirement, right? So if there are things we can do throughout the year to say, hey, we know that the shares that you should have vested throughout this year are going to be this. We can make some assumption as to what the company stock is doing and current value and where we see a projection for the rest of the year. Here's what we think the value of those shares are going to be. Here's what we know that the stock plan is essentially going to withhold for you in taxes. Is there a gap here? And if there's a gap, how can we fix that gap through your regular tax withholding or through increased deduction management, stuff like that?
No, I think that's really helpful. And it is just one of those things where it's a great thing that you don't have to do anything, or you don't have to elect it. You don't have to, accept the option or exercise the option to get the shares. But sometimes we see them pile up. So this is kind of back to that. How am I too invested in my employer's company to where now I have way too much of their stock. So when I do this calculation of, well, how much of my total portfolio, the great thing is, as these are vesting, you can be doing something with them. You can minimize that risk by moving it out of your employer stock. You don't have to hold that anymore. And so we can take that gain, move it somewhere else to maybe accomplish goals you have now, but also in the future. So that's one that is kind of helpful when you can be using it, year after year, doing something with it. So then you're minimizing that risk, which is really helpful rather than having to lock something in like some of these other options.
Yeah, and I mean, two of the big goals that we try to target and help clients with that we see commonly are charitable, right? To your example right there, if someone's got a bucket of company stock built up over time that has gain on it now, well, if you can use a donor advised fund to maybe donate some of those shares, diversify away from it, but use that donor advised fund, well, now you're skipping out on having to recognize a gain, and you get a charitable deduction, which is really cool. But another one too, to say, a lot of times we're looking at clients that have older age kids that are late middle school, high school, getting close to college. Are there options and strategies to say, let's take the risk off the table here with this one account? Let's look at a 529 account where we can get a state tax deduction in a lot of cases, or we can build up the account over time so that all the gains are tax-free for clients when they're going to eventually come out for college. So it's converting something that, hey, was nice to happen to something that's really material in your life for intended purpose.
Exactly. And that's the thing with all of people's finances, your whole plan. It's really matching what's important to you. What are those goals that you have? What is it you're trying to accomplish now and in the future? There's things all along the way. It's trying to match. What do I have? What is the best tool to reach that goal? So that's the whole puzzle that's really trying to be solved.
Yep.
So let's skip to, we talked about this a little bit, but an employer stock purchase plan. So this is now something that is voluntary. I'm choosing to purchase these shares. And we did talk about already briefly, there is a reason, there is a benefit to doing this. Again, because this is voluntary, this can also be helpful to where, again, you can get out as well.
Yeah, so I think I kind of alluded to this and maybe a little bit too fast, but just as a recap. So the ESPP, or Employee Stock Purchase Plan, this is something you basically work with your company and say, hey, I'd like to participate and I'd like to turn on this contribution. It's the same election style that you would do for your 401k. A lot of times where your 401k and the ESPP plan, they're actually in the same spot. Not always, but a lot of times that we find that to be relatively common. But essentially what you're doing here is you're saying, hey, I want to turn part of my paycheck into an employer stock, a company stock. And there are contribution limits. Different plans have different amounts, but generally we see 10 to 11. I think there's actually a IRS limit too. I don't know exactly what that number is. But there's a certain limit that you get to partake in a given year. But the big benefit that we're looking at is it can kind of be automatic free growth. Now, I hesitate to say automatic free growth because there are a lot of considerations that you need to be mindful of. Like if the company goes under, you may not be able to get your money back. You become a creditor of the company. Now, I do think you would have a very high chance of getting your money back if something were to happen, but is it a risk you're willing to take? Versus taking the money and spending it on the things you need to, or saving it in the ways that you need to separately. But with the ESPP, essentially what you're doing is every paycheck you're contributing to the company stock account, and then generally twice a year. I think those are actually the only plans I've ever seen where it's twice a year that the company will say, hey, you have X number of dollars. This is going to purchase Y amount of company stock. And hey, by the way, for partaking, for being a great employee, we're going to give you a discount on that. So if the stock was $100, we're going to let you buy it for $85 a share. And whatever the dollars you have in that account go towards purchasing that company stock. The nice thing there is, that is kind of an automatic, generally 15% is kind of common what we see. 15% gain, which you can then turn around, sell the company stock, and profit and, pay your taxes and go along the way, which is really nice. Or donate the stock if you don't want to recognize the gain. So that's one of those things where it basically is kind of like a, hey, why wouldn't you option, as long as you also say, I don't want to let this account grow up or build up in terms of company stock, and again, put more of your eggs in your company stock basket.
And again, this is one where, depending on your company, depending on how its stock is doing, like, these could change. So it isn't necessarily a set it and forget it. I'm always going to buy stock and then, just hold it. It's what am I doing with it along the way? So I think it fits really well and very similar in planning style, kind of with those RSUs. Again, what's the goal for these? What am I trying to accomplish with purchasing them? Yeah, that's helpful. All right. I think of one other, just kind of, this is like a big category because there are a lot of executives who actually have ownership in their businesses, in their companies, and they're not the owner. Take that back. They're not the founder. They're not like the sole owner, but these companies have set it up to where partners have gotten to a level to where they actually own a percentage of the company. And these are meaningful percentages due to the size of the company. Now, this is very different because it may not be something while they're working where there's taxes they're going to pay, but there also might be. So just talk to us about some of these implications. Again, kind of in that framework of like how to exercise, when to exercise. That's not really the language we would use in ownership like this, but kind of fitting it into that framework of what to do with it, and then what to know about, as far as taxes. Kind of talk through some of the big picture with.
Yeah, so I'll boil it down to the respect that really much as we look at the tax side of things, the IRS is really going to look at this very similar as they would any other investment, right? So if you buy something for $100 and you sell it for $1,000, you're going to get a $900 gain. And the IRS to say, hey, I want my pound of flesh on that. I want a portion of the gain that you received. Generally speaking, I'm using that really broadly because there are implications where it's not always, but generally speaking, you are going to look at long-term capital gain treatment so long as you hit holding period requirements. There are definitely instances where that does not work out. But essentially, if you hold it for a certain time, if you sell something for $1,000 and you bought it for $100, you're going to own long-term capital gains. Therefore, if you scale that up to say, hey, I invested $100,000 into this business, whether, hey, I purchased shares at a certain rate or, they were just kind of given to me as a retention aspect or something like that. So the basis is really low, or a variety of things or whatever they would be. And now we're looking to retire. Now we're looking to get out of the business. That transition point, we're actually find we're walking alongside a lot of people more and more frequently with that now. But it's one of those things to say, as you start taking those steps outward, what is that gain going to be? And there are different ways to structure that. But roughly speaking, again, if you put $100,000 into the business and you're going to get $1 million out, you're going to have a $900,000 gain there. Now, how do you actually materially get the funds to your bank account? Right, because they're in the company's bank account right now. You own the shares, but if you're trying to get that $1 million valuation back out, how do you get it out? One of the things that we're kind of walking alongside clients with is recognizing every company is going to do this slightly different. I think even today we've had discussions with a client to say, hey, they do it one way where, let's say you're going to work part-time and one thing happens. Let's say you're going to retire full out, another thing happens. Just recently we had another company where, hey, because they retired just before the end of the year, that triggered something beneficial to them from a tax perspective to say, hey, we're not going to recognize this income in this year. We're going to happen in the next year. So it really is really complex in terms of what are the different areas with which they can go. But one thing I will probably say is what we're not seeing is that companies are saying, hey, Trevor, you've been an employee for here. You originally contributed $100,000. Your value of your shares are $1 million. Here's $1 million check. Go have a good day, right? We're not seeing that scenario happen. More often than not, it's a promissory note where they're going to get paid out over a number of years, or some sort of familiarity like that. So
yeah, I think one of the interesting things about this form of equity compensation, this form of compensation in the way of ownership within the business, is that this is even, while you're at the company, you're working to better the company so that the value of the company is greater. That makes complete sense. But when you actually are going to get paid is after you're no longer at the company. So again, when we talk about different risk levels for different types of compensation or equity ownership or ownership in the company, these are just things you have to be thoughtful of. So, once I retire, I lock in, like, this is the value I'm going to get. This is the note I'm going to get paid over the next 5, 8 years. And so it's interesting that, you're kind of getting paid for something, but you no longer work there. And so I think it's really interesting. I think as executives that it gives you an interest in the company, beyond just your working years there. And so again, it's just a different level. And this is why we say there's different types of compensation that are given to different levels of executives. So you might have a mid-level executive who's getting the ESPP, restricted stock units, and then more of your higher level executives who are getting options or ownership in the company, things like that. And so that's, I think important to kind of just highlight. I think it's just kind of a unique thing for that.
Yeah. I mean, and even, picking apart the transition out process a little bit more, right? One of the things that we're finding is as we're looking at tax projections for not just this year, but the next 3 or 4 or 5 years, it's essentially kind of driving a wedge between some of the other planning options that we have available. Now, I'm not saying that, hey, we don't want to have clients retire, or we don't want clients to materially benefit from the businesses that they've helped grow, create, and mature over the years. But it is one of those things that we need to be really careful and mindful. And I think we do a really good job with it, of saying, how do we know that, okay, you have a business that's $1 million, it's going to pay you out over 5 years, so $200,000 a year roughly, with interest on top of that. How is that going to impact income that we're going to expect that you get? Well, if that's going to drive income substantially higher than what we expect, well, maybe we can't do the Roth conversions that we wanted to try and do for you to help look forward 20 years ahead, to see, hey, how can we mitigate your tax impact 20 years ahead? So it's one of those things where, yes, these decisions that you're making just before you retire have a massive impact on the couple years you retire. They also have an impact 20 years or 30 years, however so often. So
I think, yeah, so what's interesting is we've talked about, kind of dug into all the details of each of these different forms of compensation. What we want to do now is really kind of build out a timeline. So when we talk about, just recently, kind of a conversation I recall having is that when we're talking about all of these planning pieces, the opportunities, the strategies that you can be using, we're not talking about, okay, with this one, I'm going to do this because of this. It's not just in their own little box. It's all of these affect each other. And what's even interesting is it's not all or nothing. So we don't have to say, this entire grant that I was just given, this entire option, the amount of options, this entire, it's not all or nothing. And you don't have to do everything at one time. It can be spread out over the year, and for different reasons, you do different things. And so I just think it's really important for people to understand, it really is, there's a lot of planning you can do, and there's a lot of opportunities. So what we want to do is kind of draw this timeline in your mind. And we're going to kind of look at this window of, 10 years prior to retirement. What happens in this 10-year window prior to retirement is you're starting to think, okay, I'm going to be retiring. You've set aside funds. You're kind of, envisioning retirement's coming, and I need to be planning and preparing for that. So this is really common. And this is when you want to be thinking about, what are the strategies I should be thinking about to implement when the time comes. So you don't want to wait until the time is here or past to now think about what I can do. So 10 years before retirement, And then a corporate executive retiring, and now beyond retirement, we'll kind of walk through kind of those 5, 10 years after kind of the things we're thinking of. So in light of kind of this timeline, I'm gonna, kind of paint this picture of, an executive who has RSUs, options. They've got these different types of stock. That's great. They might be purchasing employer stock, stock through the employer stock purchase plan. And as they're, they also have, maybe some deferred comp, or they've got a pension that they've got to decide how or when do I want to take this. So as we kind of think of someone who has maybe all of these things, oh, and by the way, I'm part owner, in this company as well. So I've got to figure out how and when to take those shares. What we want to do is kind of help you understand, okay, 10 years before retirement, let's say we're 10 years before. So each year you're, getting granted these different forms of stock. So as I'm getting granted these different forms of stock, what should I be thinking of kind of on this timeline of I know where I'm going? What are some thoughts that come to mind for you?
Yeah. So as you were kind of sharing that, I was also writing notes of just making sure I'm on the same page with the timeline. As we look to more of the equity compensation, thinking the RSUs, the ISOs, the NSOs, stuff like that. That's where, especially 10 years prior, about kind of around that threshold over you're going to retire, that's when I would probably start leaning towards having clients think through, hey, do we really want to hold on to these shares? Maybe we've been holding on to them for years past. That's really the point where we might want to encourage clients to say, hey, let's think about other options that might be available to you. And the reason for that is because, again, as we look ahead, this client, as you mentioned, if they're going to involve deferred comp, they're all going to be a partner in their business, if they're going to have a pension, stuff like that. I'm looking at the retirement plan and saying, well, gosh, we have a whole lot of company-focused things all going to hit at a very small time window. I really want to mitigate as much risk as I can for the client, recognizing that, hey, after they're done working, like they're done working, right? The last thing I ever want a client to have to do is to say, hey, we had all these numbers, and as long as the company holds up in a certain way and this and that, you're going to be good to go, and the numbers don't materialize, you're not able to do what you want to do. Like that's a feeling, a conversation I never want to have with a client. So what are the things we can do to start offloading that risk? So with RSUs, the ESPP, the ISOs, NSOs, what are we doing in terms of being able to offload or reduce our exposure in that regard? Even on the ESPP side, since we can control that to a certain degree, we might even consider, if we don't have substantial cash reserves or in a taxable brokerage account, maybe we're minimizing the amount that we actually contribute into that account over the next couple of years, recognizing we're also kind of giving up some material benefit. But again, we want to minimize risk to the best extent that we can.
Yeah, I think that's a really big one for that time period. Also, just thinking about it, because if you're thinking you want to retire, when someone retires, they're not thinking, if this doesn't work out, I'm just going to go back to work. No one's thinking that, So it is really making sure you have a plan so that when you say that time has come, you're able to do that. So investment risk is a huge one. When we're kind of even pairing some of these, and I think of, maybe you're matching it to something you want to accomplish, for example, as we're maybe exercising some of these the stock or selling it, even pairing it with goals you have in the future. So if you like to give charitably, like you had mentioned earlier, if we know we're going to have high tax years, let's match it with something that can offset it, that I can use at any point in the future when I want. And so charitable giving can become a really big part of balancing out that tax bill that you're going to have.
Exactly. The other thing I thought of and whatnot, and I'm going to add a timeline in here if you don't mind. So I know you said 10 years before. I would say 5 years before kind of your target retirement date. That's when I would want to make sure that we're getting really careful with the elections that we're making on any deferred comp. Meaning to say, we want to understand what is the potential deferred comp income going to look like. Because remember, if we've been participating in this plan for years and years and years and years, those are values that have probably grown, right? So depending on the elections that we've made in the years prior, that's going to impact the maybe single year, 5 years, 10 years later through on. So the 5 years before retirement, when generally we have our highest income years, I want to make sure we're really careful to say, well, do we want to push this income out and increase a future retirement year? Or do we want to go ahead and take it this year, maybe offsetting with, as you're mentioning, charitable deductions or something else, goal-wise otherwise. So that's another thing I want to be really, really careful with, probably 5 years before retirement, to kind of dig in through there. So
I think another common thing that people think of when they think I'm retiring, they think that's when my paychecks end. So there's no money coming in. And that's where this danger of, but you're still going to have income potentially. And that comes from pieces, like you're saying, of that deferred compensation. So what you're electing 5 years and even more before retirement, but whatever you elect before retirement is now actually going to start to come in as income after you retire. A lot of times that's the trigger date of retirement, is when you start receiving that money. So the paychecks don't end, they just change where they're coming from. And so that's why this becomes so important. So deferred comp is a great example of that. A pension is another great example where someone might be able to take a lump sum of their pension, or they might be forced to, take it out over the rest of their life. But also, what percentage do I take of that? Do I elect kind of a spousal election for my pension, so it's over both of our lives? Those are things too that impact the amount that you're receiving kind of in that, income beyond retirement.
Yeah, and that's why for clients that have pensions, we're really, really careful with what those are, because it's not just you're looking at that in isolation, right? Because, hey, you can make a really good decision of these variables, these inputs, that's the decision that you need with this pension. But the reality is, when you start incorporating deferred comp, when you start incorporating business distributions, when you start incorporating, life expectancies and stuff like that, there's a whole lot of other benefits or other levers here that we need to make sure that we're not tripping or running afoul of. So sometimes it's actually one of those situations where you might actually want to give up some of the financially best option in order for more flexibility. And that's actually okay, right? We're recognizing and seeing where, hey, clients are saying, this is the financial best option. We can walk them through here's how the numbers shake out. This is what we think would be the financially, optimal path to go. But the reality is, if you want more flexibility in life, sometimes we need to give up something. And that's where, sometimes with those elections with pensions, that's where we want to be really, really careful with what we're doing there.
Yeah, no, I think that's really helpful. So now if we extend this timeline, so now we've been retired, and we still have income coming in from all these different sources. We're also, receiving the payout from maybe that 5-year payout of the ownership that we had in our company, which again, these are not necessarily small numbers. So we're receiving that, and we have tax planning opportunities in those years. And now when we move, beyond, so age 73, for example, where all of these things we've been talking about, we haven't even touched their 401k. Remember that you were saving into every year?
Yep.
We haven't even started taking money from that because you have all these other forms of compensation. And which is, I think, a lot of times really surprising to people. So now age 73 comes, and now we have to start taking RMDs. And it's a different age for everybody, but I'm using 73 as an example for some people when they start. But that 401k, you have to start taking money out. You're required to at that certain age. And so now, again, we've got income coming in that maybe we don't need. This is where, again, with all of these planning opportunities, that RMD that we take, what we're doing in those 10 years before retirement, all of that can affect how much we have to take out now when we're older in these RMD amounts. And so it's all of that you're trying to structure in this really big timeline. A lot of times we'll say it's not necessarily, we're choosing what our taxes are, but it's really the timing of when you're going to pay them, because the timing of when you pay them, you're going to have potentially different brackets you're going to be in across that timeline. So we're trying to match the year that you're going to pay those taxes with the amount you're going to pay so that they're in the right bracket, and we're not paying a really high year and a really high bracket, but we're spreading it out based on what, tax legislation or tax rates are at the time. So it's really kind of putting this whole big picture together. And I think hopefully this is helpful for people listening, saying, I have all these benefits, but I don't really know how they work together. So I think this is kind of helpful to understand it kind of on a timeline of, okay, they all serve a purpose. They're all increasing your wealth. But now it's, how do I use this? And I hope this has kind of given people an idea of some of the planning that can be done for you in this situation.
Yeah, and even as a takeaway on that, like the ideas of using timelines. This is something we use internally for a lot of clients as we're looking at projections. We have a lot of variables associated with ours, but it can be as simple as literally writing down year by year by year. Maybe now, like you're approaching retirement, you still have some years or whatnot, but just writing out on a spreadsheet or even on a piece of paper, hey, here's what I expect. And it doesn't have to get fancy. It doesn't have to be really nitpicky of, well, that's going to my 401k, this, that. What's your total income coming in? And what is it going to be next year, and the year after, and the year after, year after? And just start kind of laying those dollars out. And that kind of can give you some reassurance to say, well, gosh, I was really worried about what might happen in retirement, but I realize I'm going to have 80% of my income already covered from the things that I've already done the entire working career. And for a lot of clients, that can give them confidence to say, well, gosh, I've been working so hard for so long. Why am I doing this anymore? And the joy I get sometimes is you kind of see their eyes widen up and be like, well, maybe I can actually stop working sooner. Yeah. So, or maybe I can start spending more money. I can go on more traveling, whatever the case is. So,
and that's the other thing we didn't mention is like this timeline. We're saying 10 years before retirement, but is that 50, 55, 60, 65? Like it could be different for everybody. And depending on what that age is, that can throw in different factors like Medicare, Social Security, pieces like this. So when you really look at the complexity of everything going on, the goal is to make it very simple. Put it on, we're wanting to build this timeline for your money to achieve what you want to achieve. That's the goal here. So I think this has been really helpful. There was a lot of technical stuff we wanted to explain and understand and get through. Any final thoughts, Trevor, you kind of have on really helping corporate executives understand really this equity compensation they have?
Yeah, I think just the one big comment on it, and I think I led it off with this, is there are a lot of complex and technical items here, but at the end of the day, it can be boiled down, right? And if you find yourself kind of getting overwhelmed with all the complexities and the details, I would just say if there's any way that you can say, okay, step back. What does this really mean? Like, what is this dollar amount? Like, if the company says they're gonna, spread out my $1 million valuation over a 5-year, you could get nitpicky and say the interest is this, just write down $200,000 a year, and just, kind of go through there and then just get some comfort level of where you think those figures might be, of what they would imply doing. And as you have questions, just to say, jot down those. And if you have questions, we'd love to answer them. I genuinely love kind of getting through the nitty gritty and popping open some spreadsheets to run some analysis. So, it's just one thing that brings me joy. So.
Yeah, exactly. And that's what we love doing this all year, every year for people. So as you move through that timeline, it's exciting to see, okay, you're able to do the things that you wanted to do because of the planning you were able to do and the opportunities that you took advantage of. So, well, thank you so much for joining us, Trevor.
Yeah, sure thing. Happy to be here.
Well, thank you for listening, and you can find a couple of the related resources that dive further into strategies for these executive benefits in our show notes on our website. If you find yourself wondering if you're really maximizing your executive compensation, that's where a team like ours can help you. We plan out every opportunity so that you can enjoy life knowing your plan is on track in the most tax-efficient way possible. Take a look at our website, but until then, we'll talk to you in the next episode.
Thanks for listening. To find any links or resources related to this episode, check out our show notes. Your host was Michelle Smallenberger, a certified financial planner and CEO. The guests featured are from Financial Design Studio, a team of experienced fiduciary, fee-only advisors based in Chicago. Anna Lewis is the executive producer of the Behind the Designs podcast. And as always, for more information about Financial Design Studio and who we are, check out our website, financialdesignstudio.com. And final note, no content discussed on this podcast should be taken as financial advice. Financial Design Studio accepts no responsibility for your individual choices. We'll see you in the next episode.